Hello and welcome. It is, what's that time?
Burn
Burn
rate
rate.
and beyond time.
Um, yeah, my name is Chad Fultz, and I'm here with the always smiley Jeffrey Mazza.
Hey everybody, how are you?
Right. Today our topic is optimizing revenue recognition. Yeah, here we go. I think that's one of those potential topics, Jeff. Correct me if I'm wrong. Lots of people will be like, "Is that even an option? Why How can you optimize revenue recognition? You just when you make money, you recognize it. So I guess there's a couple things to talk about here. What is revenue recognition?
Yeah, just diving right in. It's very important. I think a lot of folks don't, I don't say follow, not because they don't want to. It's just that they don't know how, or not really educated to know how. But revenue recognition in itself, or excuse me, like based off of, the revenue rec is really kind of recognizing that revenue when that revenue is actually earned, not so much when that sale took place per se a lot of times, but yeah, it's a lot of times there's a ASC 606, which is the actual revenue recognition policy from the accounting standard codification, that really emphasizes what that is, but just a way and when that you should put that in your books as revenue.
And I mean, okay, so that makes me think about um, what's it called? Good old accounting, right? Like there's this thing in there's two basic concepts in accounting, right? It's like there's cash basis accounting and accrual basis accounting.
Yep.
So, most people say, cash is king. That's what really matters. Like, what do you got in the bank? And, but this is sort of saying, well, there's a disconnect, right? Like, you might get the cash today, you might earn the cash tomorrow, you might earn the cash yesterday. And so I think that's what we're talking about here. Am I getting that right?
Oh, 100% right, right. And that's where, from a cash accounting side, where that's when everything is recognized when cash exchanges hands. But from the accrual side, that's where the revenue recognition comes into play, and it's really based off of the matching principle. But that's really just kind of aligning those expenses that incurred the same period with the revenues that were kind of generated to help align those costs, to put them in the right bucket. So um, it's
And why do we care about that? Like, like, the whole like aligning, like the matching, like why is that even important?
Well, I mean, for business owners, I mean, it helps make good business decisions, right? It provides clarity. Um, it's especially for like the reoccurring, I guess, revenue, long-term kind of contracts, especially the SaaS-based business too. But sometimes if it's like front-loaded and you're not recognizing it, and margins might be like all over the place, right? And it's hard to really decipher like how are you doing? Is that revenue for a specific period of time? Um, is it all on one side? Is it kind of all in 1 month compared to, that's really 3 or 4 months or a year, whatever that contract is. But so that's why it's kind of important there.
Okay, I guess maybe the more fundamental thing to talk about here is contracts. Like, so you have a contract, you have a month to month contract, right? It's
Hmm.
just this month we do the work, this month we get paid, and next month if the client says no, we don't do the work and we don't get paid. So that's like the simplest contract, right? But then there's lots of other kinds of contracts, right? There's I guess there's like an annual contract. Are there any other ones that we need to think about here?
Well, and I think the annual one, and you see this all the time. I feel like just to kind of like maybe the audience will kind of be able to kind of relate a little bit, but it's at least like think about a subscription, right? Where you're like, oh, you can pay on a monthly basis, or you say, hey, for a little discount, you can give you all that money for the entire 12 months, right? Well, that company, for instance, if you pay $1,200, right, that for a 12-month subscription, they're not going to say they got $1,200 of revenue. They're going to say $100 every single month for that revenue for the entire year of that contract. So just for some maybe some clarity for some of those listeners that might not know or not familiar with what actually ASC 606 really is and how you use it. But to your question, yeah.
That makes me think. I've heard a really, really great accounting joke about that. It says, "Why did the accountant show up at the ASC 606 training with a ladder?" And because they heard that revenue recognition happens in 5 steps, and they wanted to start climbing right away.
That's good. You gotta laugh about it.
Okay. The bar's pretty low. Anyway, so there's 5 steps. There's 5 steps
I love it.
accounting for in the ASC 606 has 5 concrete steps, right? And so the first one is identify the contract, right? So I think there's another one that's interesting is like the example you used is the example of like a fixed $100 fee every single month, right? And so cool, you can pay the $100 today, or you can pay that $1,200 today and get access for 12 months, and maybe there's a little discount in there, maybe it's $50 off or 10% or whatever it is, right?
Yeah.
The third kind of contract is just sort of a prepaid contract where maybe you pay the $1,000 up front, but it's a variable cost every month, and so no one knows until those months happen how many users are going to be on the system or how many API calls are going to happen that month. So it can be prepaid, and that can be a discount for the customer because they're willing to put the cash up front, but for the company who's actually doing the work, it's like, okay, well, this month maybe it's 95, and next month it's 120, and the month after that it's 150, or
Yeah.
maybe it pulls because it's seasonal, So there's another one where it doesn't always have to be just boom, we're going to do the fixed fee every single month. So the concept is like identify the contract, right? So then I think contracts have like a few key clauses, right? Like who the parties are and
Yeah.
kind of the
Like
term.
obligations, right? Like what's like the promise to deliver, I guess. Like what does the language look like, things like that. So
Yeah.
it's important.
So step 1 is the name of the contract. Step 2 is the performance obligations, right? So it's like, okay, well, we're going to, like I was saying, fixed amount every single month. That's the promise, or is it promise to give as many access to as many users as the client needs? Okay, so that's 2 steps. Anything to add on that one about the performance obligations? It's pretty straightforward.
Yeah, pretty straightforward. It's just, what are you telling them, or whether they're the client, you delivering a service, a product, but what does that state, that obligation?
Yeah. Then third is determine the transaction price, right? So is that like the fixed monthly fee of the $100 a month, or is it X number of dollars per user, and that can change? It can be either one. And then step 4, of course, is allocate the transaction price to performance obligations. So that's where you kind of line up that $1,000 or the $1,200, over each individual month for a year.
Yeah.
Or step 5 is recognize the revenue. So those are the good old ASC has put together those 5 easy steps. Easy to remember, I don't know, easy to execute. I guess have you found it hard, or have you found, or like where's the trickiness of doing this?
Well, I think it depends on, like, for instance, like a SaaS or subscription based model, right? If you're talking about thousands and hundreds of thousands of users, like this massive company, you're going to need some sort of software to help you manage that. Otherwise, you can do this in Excel, even if it's very basic way, which is still fine. But once you start to getting and adding those layers of complexities, it starts to get a little bit more complex. And then, kind of like, formulas start getting messed up and you're just lost in the weeds. But for me, it's the more that you have, the more likely you're probably going to need a little bit of extra help to kind of manage that.
Yeah, because I think the part of what do I call it, the actual like I guess the key here is like how many are we dealing with?
Yeah.
because if you have one, if all your clients are monthly except for one who's an annual client, okay, well, I guess that's the other thing too, right? Like, let's say you have 1,000 clients and all of them are monthly except for one client that pays on an annual basis. Okay, so do you need to worry about this? Is it material? Like, do we care?
Yeah, I mean, when you have one, I mean, if this is an accrual-based accounting, kind of the accounting method used, then yeah, you got to follow the AOC. I mean, listen, if you're a private company and you're not following it, you could put some disclaimers in there, footnotes that says, listen, we're opting not to follow ASC, just to disclose that, but recommend just getting in the good practice of doing it.
Well, I guess that's the thing, is it's like, and I guess that's kind of where you get back to if it's not a public company, like, who are the users of the financial statement? Who's going to care?
Exactly. Yeah.
Is it the bank? Is it management? Or is it future potential investors? So this is where our current shareholders, even if it's a closely held corporation or company. But it's, so that's like one of those things, like I feel like I've seen a number of companies who are just doing a cash basis. They're like, we got the money, we put it on the books. We got the money, we recognize the revenue. Just keeping it easy and simple.
Yeah.
But then they're like, someone's like, well, what's your run rate? Do you know what your ARPU is? What's your monthly profitability? Are you
Yeah.
tracking? And they start saying, what? I don't know. There it is. We get, X number of dollars per month. Right. And that's where I think this transition often happens, where clients are saying, the founders are saying, oh, okay, we got to figure this out, because it starts to it makes the business, I think you said this earlier, it makes the business easier to manage and understand. Like, if your margins in 1 month are huge because you had a bunch of annual contracts signed are paid, then the next month they're terrible because you didn't get any money that month because you got a bunch of money the month before.
Yeah.
What's going on in the business? So I So I feel like there's like this inflection point of complexity with both the needs of the business and like the evolution of the business.
And that's a good point too, especially if, privately held company, a very small business. Like, do you have to, let's say, follow, the ASC, the GAAP accounting rules when you're a cash? And it's like, well, technically, no. You're small. I mean, it's probably recommended that you look at, more of the accrual side of the accounting, but it's not like, you're going to be punished if you don't do that. It's like, no. But it's just, to me, it's good practice if you're following that model, and where you're going with the business. So you're going to look to grow into this big company to go public or something, then yeah, you should probably get in board with that now, sooner than later.
Yeah, and it'll just make the business easier to understand.
Mm-hmm.
Okay, I guess the other thing that I was going to show here was you mentioned software, or software, and not just software as a service, but software to help manage it. So we have one image here that I'm going to bring up that can help people understand a little bit of what we're talking about. So let me see if I can get this going and everyone can see what I'm talking about. All right, and yeah, there we go. Okay, so what we're showing here for those folks who can't see is basically, it's a graph demonstrating when new client contracts are signed over time, and this is specifically contracts that are for a period longer than 1 month.
Okay.
So we can see that there's a lot of variability, and we can see that, for example, if we look at October 2024, in this particular example, there was less than $40,000 of new contracts signed. But if we look in December of 2024, there was almost $200,000 in that 1 month of new contracts signed. And
wow.
and so there's two pieces that happen here, right? So if we were just doing cash basis accounting, October looked like a terrible month, and December will look like an amazing month, right? But in reality, we need to smooth that out. And so what ends up happening is we get something that looks like this. And this is the revenue that's recognized every month. And over time, you can see we're here somewhere in, the middle of 2025 right now when we recorded this. You can see that as the contracts start dropping off, and if new contracts aren't signed, they eventually go down to essentially zero. So what happens is every month that a new contract is signed, more things are added, and this little hill continues to go out into the future. So this is sort of this is what we'd like to see. We'd like to see, okay, well, what happened? Something happened here between September and October of 2024 that, a big contract that existed fell off and wasn't renewed, or was renewed at a significantly lower rate, right? So this is where there's actually insight into the business that you can see when you look at a graph like this versus when you look at a graph like this. So
I love it. I think it's such a great visual, Chad, especially when we're talking about this, and because you could clearly see the choppy waters here, and like, how do you make sense of this? How do you plan for that compared to the cleaner version? And just to confirm, right, that's just if no other new subscriptions were signed, the ones that are currently now would actually just kind of fizzle off as they expire.
Right, exactly.
Okay.
For the people who are just listening and looking, this is a sort of what you might think of like a tabletop mountain or a mesa or something like that. Look, where it's kind of ramps up, it's flat, more or less flat at the top, and then ramps down as time goes on.
Yep.
And the thing is saying, and that's why it ramps down, because the assumption is no new contracts are being signed in this particular model that we're looking at.
Yeah.
And there's two pieces to this. One is you can there's two pieces. If we go back to the choppy one, we can also see when contracts were signed. So December is a popular month for this particular client to sign contracts. We can see that in the end of the year, I should say, December, January 2023, 2024 was two big months together. December 2024, January 2025 were both pretty big months. So for this particular client, that's a time where lots of contracts are signed. So you can also plan around those time periods and understanding, okay, well, we have contracts that are coming up at the end of the year, and if we're going to sign them, if we're going to renew them, I should say, then we're going to get there's going to be a large cash influx, and we're assuming these are annual. Most of these are annual contracts. We're going to get a large cash influx around December, January, because of those contracts that are being signed. So it also helps with cash flow planning, even though we're keeping the books on an accrual basis. This kind of analysis helps you understand where the cycles are and the seasonality in the businesses.
That's where I feel you makes really good business decisions based off of that compared to the choppy waters of the other sheet there. I don't know how you would.
Okay. Yeah. So anyway, this is just an example of something we put together as a part of doing ASC 606 recognition for our client, just kind of help them see what's going on and understand a little bit better. Well, cool. I guess any other comments here on this? This is a pretty straight. I think it sounds intimidating to some non-accountant types, but I feel like it's pretty straightforward.
Yeah, no, it is. I think the terms themselves can be a little daunting, but once you kind of take a little dive into it and either kind of use a software like that, a visual, it's very easy to kind of comprehend. And once you understand it, it's very, very easy to do that. But it is very, very helpful in many ways that you just referenced there.
Yeah, good stuff. So I think the big takeaways here are, it makes sense to start doing, well, if you're not required to follow ASC 606 because you're a privately held company, it's a good practice to do so regardless.
Yes.
That's the biggest thing that we've talked about here. And the title here is optimizing revenue recognition. So this is sort of a process, right? Because optimization is all about you do it once and you get a little better. You do it again, and you get a little bit better at that, right? So
yeah.
Where's the optimization coming here?
I'm sorry, say that one more time, Chad.
I said, where does the optimization come in here?
Oh, to me, because it's really understanding like the flow, kind of the graph that you referenced, right, and making those decisions of when the certain revenue, the seasonality of it, certain, churn, like to me, that's really kind of how do you, optimize the revenue that you have right now? Because you might need a big push knowing that, oh, there's a lot of contracts that are coming off in 6 months that you're not even sure if they're going to renew. Like that's, somehow you're going to have that visibility, but it kind of gives you the insights into, the optimization of revenue and when it's recognized. So that's how I would look at that.
Interesting. Yeah, and I guess that's the thing. The optimization piece is like, how do you fold it back into operations, right? And say, okay, well, A, we're optimizing the books so we have the most representative of what's going on in business, but then B, improving business decisions.
Yeah.
So good stuff. Good stuff. Well, I don't have any other corny accounting jokes to share. I'm sorry. I know you're really on the edge of your seat there, hoping I help.
But you had some visuals today, Chad. So who doesn't like a good graph or visual? So that was pretty cool. So
Exactly.
thank you for sharing.
Yeah, definitely makes it a little easier to comprehend some of these more obscure topics. But anyway, good stuff. So big takeaways are, yeah, go for it. If you're ready to take out that to bite off that chunk to recognize revenue and in a more I guess orderly fashion. All right. Well, I think we're gonna wrap it up here. Until next time, if you have any comments or any other things you'd like us to see, feel free to reach out.
Thanks, guys. Have a good one.
All right. Take care.